We're looking at practice exam 7, and this is problem 1. The exam only has 3 problems. You prepare a cash flow statement, like we learned, and not even the whole thing, just the cash flows from operating activities. So that's question 1. Question 2 is going to be a horizontal analysis. Question 3, vertical analysis. So there's only 3 questions, so each question is worth kind of a lot of points. So first question is prepare the cash flow statement. And what you'll have is the 2 documents you need to do it, an income statement and a comparative balance sheet where you've got the 2 years worth of balance sheet account balances. Alright, so the question is do just the cash flow from operations. So you don't have to do the entire cash flow statement, just cash flow from operations. Alright, so in order to do that, the first thing you have to do is put that title on there. This is Gryffindor Company, and it's a cash flow statement. The operations section. Right, it's not the whole cash flow statement. And this is December 31, 2016. Alright, so we start out with the title of this part of the cash flow statement, and it's cash flows from operating activities. Alright, and so then we have start with the net income, right? So you just start with net income, and that's pretty easy. You just go to the income statement and you find it. It's always the bottom line, $28,300. Now we're going to do our adjustments. So we tell people what we're doing. So adjustments to reconcile net income. Oops, sorry. Reconcile net income to net cash from operating activities. Okay, so that's what we're going to do now. We're going to do our adjustments. So the first adjustment you always do is, if there is depreciation expense, you add that back in, and it's always an add. So depreciation expense. Why? Because it's a non-cash expense. It shouldn't have been taken out of the cash flows. Oh, that's the balance sheet part. Of course, expenses are on the income statement. There we go. Depreciation expense, $2,100. So you add that back in. Alright, now we're going to look at the changes in the current assets other than cash and the current liabilities. Alright, so I like to just kind of like remind myself, no, I'm not going to get I don't need the cash. Alright, so we got to take our differences, right? So accounts receivable is the first one, and accounts receivable decreased by $500. I can tell that just by looking. $2,500 minus $2,000 is a decrease of $500. So I'll just write that down here. Decrease in accounts receivable is $500. And because it's a decrease of a current asset, I add it back in, right? think about it. If if accounts receivable went down, that means some cash must have come in, right? So the cash is flowing in. All right. Next current asset is merchandise inventory. Merchandise inventory changed from 31,400 to 38,000. So that's an increase of 6,600. All right. So if you think about it, if you purchased inventory, I guess you had to pay for it. So cash went out. So an increase in inventory means you're going to subtract it from the cash flow, right? So an increase, so here's with current assets, whenever it decreases, you add. Whenever it increases, you subtract. All right. That's all the current assets. So now we got to look at current liabilities. Well, we have two, all right? So the change in accounts payable went from 8,200 up to 9,100. So the difference there is 900, and that's an increase in a liability. So we increased accounts payable. So for liabilities, it's the opposite. When you increase an account payable, that means you add the cash. Right up here, when you increase an asset, you subtract it. But when you increase an account payable, you add the cash. And the next thing, accrued liability. So those are your taxes payable, salaries payable, those things you accrue at the end of the month. You went from 12,003 to 11,002. So you decreased that. So you decreased accrued liabilities. All right. And that was the difference between 12,300 and 11,200 is $1,100, which we're going to subtract. Why? Because think about it. If you decrease the liability, you must have paid out that money. So the cash flowed out. So it makes sense with the cash flows, right? So now we're going to add these up. All right. So 2,100 plus 500 minus 6,600 plus 900 minus 1,100 gives me a negative 4,200. All right, so that's a negative number, so we got to subtract it. 28,300 minus 4,200 is equal to 24,100. Now, if that had been a positive number, right, let's suppose those were all like positive numbers and you added them up, then you would add that because cash would have flowed in. But in this case, cash flowed out. It's negative. So we have to take our net income and subtract the number. And this needs a title that is called Net Cash from Operating Activities. All right, and you're all done. You don't have to do the rest of it. We're just doing cash flows from operating activities.